Right now, China is executing a plan to weaken the US dollar while still holding around $850 billion in US Treasury bonds. The world's largest foreign creditor is building the system designed to replace American financial power, step by step, while still sitting inside the dollar system. June 2024, China accelerated its central bank digital currency rollout. The same period, BRICS meetings intensified around alternative settlement systems. The same year, China continued adding gold to reserves. To most people, this looks like a contradiction. It isn't. It's a controlled exit strategy, a long timeline move. We are not at the beginning. We are deep into the plan. Wall Street is already positioning for what comes next while Washington performs political theater. And there's a pattern that has ended every reserve currency dominance cycle for centuries. Understanding that pattern shows exactly why China can't crash the dollar overnight, when the dollar starts losing reserve status, and what happens to your dollar-based assets when the timeline completes. Let's start with what China says out loud. Xi Jinping has repeatedly criticized dollar dominance and called for a system that reduces reliance on the dollar. China has made it clear it does not want to live under a world where the United States controls the financial plumbing. And the fastest way to reduce American leverage is to build alternatives, payment rails, settlement systems, trade invoicing, and reserve assets that do not require dollars. China does not need to attack the dollar directly. It just needs to reduce global demand for dollars over time. Now look at what China has actually done. In 2020, China launched the digital yuan, making it one of the first major economies to deploy a large-scale central bank digital currency. By 2024, expansion accelerated across many regions and major cities, with large-scale trials and integrations across payments. The key point is not the number of wallets. The key point is the system itself. A state-backed digital currency network that can run domestic payments at scale and potentially support cross-border settlement without relying on US-controlled rails. At the same time, BRICS has been holding repeated meetings since 2023 about building alternatives to the dollar system, not just speeches, working groups, concepts, settlement coordination, trade routing. Whether it becomes one new currency or simply a web of alternatives, the direction is the same: reduce dollar dependency. Then there's Belt and Road, over $1 trillion in projects across roughly 150 countries, building roads, ports, railways, power, and telecom. This is not charity. This is infrastructure leverage. And increasingly, many contracts and financing arrangements lean toward Chinese currency settlement or non-dollar terms. Chinese construction, Chinese financing, Chinese suppliers, Chinese settlement. This creates long-term demand for yuan-based systems. Now add the gold. China's official reserves are large. Many analysts believe the true number could be higher than reported when you include indirect channels. The exact number isn't the point. The behavior is the point. China has shown consistent interest in increasing gold exposure over time. Gold is neutral. Gold is outside US control. Gold is what countries accumulate when they're thinking about monetary sovereignty. So the message is clear. China wants out of dollar dominance. China is building exits. China is telling you it is building exits. Now here's the other side of the equation, the part most people ignore. China still holds a huge amount of dollar exposure, not just treasuries. As of 2024, about $850 billion in US Treasury holdings. But that's only the visible piece. Add other dollar-based assets, corporate bonds, bank deposits, trade receivables, and global reserve holdings. Chinese banks and institutions also have dollar loans, and Chinese corporations owe large amounts of dollar-denominated debt. Total exposure is often estimated in the trillions. That's the trap. China cannot simply crash the dollar without crashing itself. Do the simple math. If the dollar fell 30% rapidly, China's dollar assets would lose massive purchasing power. Hundreds of billions could evaporate in real terms. That's not abstract. That's real wealth destruction. That's more than many national budgets. That's why China does not want an explosive collapse. China wants something else: a managed decline, a controlled demolition, a slow shift, a transition. This is not unprecedented. Britain faced a similar challenge in the early 20th century. The pound was dominant. British capital was deeply tied to pound-denominated assets. They could not just destroy their currency without destroying their own wealth. The transition from pound dominance to dollar dominance was not a one-year event. It was a long process across decades, accelerated by wars and debt realities. Japan faced a related trap in the 1980s and 1990s. Japan accumulated huge exposure to U.S. assets. When policies and currency adjustments shifted, Japan absorbed losses and still remained tied to the system. This is a pattern. Once you become a major holder of the dominant currency, you're trapped by your own success. You can't burn down what you own. China understands this. China studied Britain. China watched Japan. That's why China isn't trying to crash the dollar overnight. China is trying to reduce dollar dominance without detonating its own reserves. The correct framing is not China will crash the dollar. The correct framing is China is building the world that makes the dollar less necessary. So the real question becomes, how long does China's exit take, and where are we in the timeline? China's strategy runs on a three-phase mechanism. This is not random. It mirrors every reserve currency transition in history. Different technology, faster communication, tighter execution, but the same framework. Phase 1, build alternative infrastructure. Phase 2, test and expand alternative systems. Phase 3, trigger the transition event, not a sudden collapse, more like a tipping point. Phase 1, build alternative infrastructure, 2014 to 2020. This is where China quietly built the base layer. While the world focused on headlines, China focused on plumbing, payment networks, development banks, currency recognition, energy settlement mechanisms, digital currency pilots. 2014, China's domestic payment systems grew stronger. Union Pay expanded scale. Domestic dominance matters because you can't build global influence without stable home infrastructure. 2015, China launches the Asian Infrastructure Investment Bank, a competitor structure to Western-led lending systems. This matters because reserve currency dominance is not only money, it's lending power. The IMF and World Bank shape global finance terms. China wanted its own tool. 2016, the yuan joins the IMF's SDR basket. This did not make the yuan dominant, but it gave it recognition, like a stamp of legitimacy in global finance. 2017, oil-related yuan settlement mechanisms expand. The goal, give trade partners a path to transact in yuan with optional conversion channels. This challenges the decades-long petrodollar structure that supported global dollar demand. 2019, digital yuan pilots begin in multiple cities. Controlled testing, controlled rollout, user behavior study. 2020, expansion accelerates with deeper integration into major platforms. This is critical. China didn't build a digital currency in isolation. It built it into systems people already use. During the same phase, China built its cross-border payment alternative infrastructure. The most famous example is CIPS, designed to reduce dependence on SWIFT's messaging dominance. Many people misunderstand this. It's not that SWIFT is money. SWIFT is plumbing, messaging, routing, and plumbing is power. Phase 1 was quiet. No dramatic confrontation, no one-day declaration, just systems, alternatives, and options being built while the world argued about politics. Phase 1, complete. Phase 2, test and expand, 2020 to 2027. We are in this phase now. This is the phase where the system begins to function at scale, domestically and internationally. The digital yuan expands. Cross-border trials grow. Payment infrastructure handles larger volumes. More trade gets settled outside dollars. Here is what matters in phase 2, adoption and volume, not speeches, real usage. Digital yuan moved from concept to wide trial scale. Cross-border pilots expanded through key hubs and partner countries. This is how you build habit and normalcy. CIPS volume reportedly increased dramatically in recent years. The exact number isn't what matters in a script like this. What matters is the growth direction. China is pushing a settlement option that reduces the need for dollar intermediaries. Currency swap agreements are another major weapon. China has created swap lines with many countries. A swap line is simple. Two nations agree to exchange currencies directly when needed. That means trade can continue even without dollars. The more swaps exist, the less global trade requires dollar reserves. Now look at trade settlement behavior. Russia-China trade shifted heavily away from dollars after sanctions pressure increased. That shift wasn't invented in 2022. It was enabled by the Phase 1 infrastructure built years earlier. This is the key pattern. Crises accelerate adoption of systems that were built quietly before the crisis. Now watch China's treasury holdings over time. In 2013, China peaked around $1.3 trillion. By 2024, roughly $850 billion. That's a major reduction over a decade. But it wasn't done through a dump. It was done gradually. And this is the crucial mechanic. China often doesn't sell aggressively. It lets bonds mature and simply doesn't reinvest at the same rate. Treasuries mature. China gets principal back. Instead of rolling all of it into new treasuries, it redirects into other assets: gold, euros, strategic commodities, belt and road funding, domestic priorities. This is how you exit quietly without crashing the market. Now, here is a huge piece many people ignore: Saudi Arabia. If energy settlement shifts materially away from dollars, global dollar demand changes at the deepest level. Even a partial shift matters. Even 10% to 20% is meaningful. A larger shift would be historic. This is why this is a timeline plan. China is building settlement capability so that when partners are ready or forced to use alternatives, the system already works. Now we come to the uncomfortable truth. Wall Street sees this. That's why major firms expanded positioning inside China and Asia, even during political tension. Because financial capital doesn't fight history. It positions ahead of it. Politics is the show. Capital is the reality. In every transition, elites move first. Phase 3, trigger transition event 2027 to 2030. This is not one single event like a movie explosion. It's a tipping point. The moment where more international trade and reserve behavior shifts into a multipolar structure and the dollar becomes one major currency among several, not the dominant foundation. What could trigger it? Several possibilities. BRICS could formalize a commodity-linked settlement unit, not necessarily a new currency in your wallet, but a settlement standard that reduces dollar share. Saudi Arabia could expand non-dollar settlement materially. A large emerging market bloc could adopt digital yuan settlement rails for a meaningful portion of trade. A major geopolitical shock could push more nations into alternative structures faster than expected. The outcome: the dollar doesn't vanish. It loses reserve dominance, it remains used, it remains valuable, but the privilege weakens. Now put this into historical perspective. Reserve currency transitions take time. Dutch guilder dominance shifted over decades. British pound dominance shifted over decades. The transition from pound to dollar stretched from World War I through Bretton Woods. It wasn't sudden. It was recognized officially only after the shift already happened. That's the pattern. The official announcement comes after the financial transition is already real. Britain didn't wake up one morning and lose reserve status. It weakened gradually through war debt, shifting industrial power, capital flows, and system stress. The US became the creditor. Britain became the debtor. That forced the financial center of gravity to move. Britain tried to maintain dominance. It created the sterling area. Countries pegged to the pound and held pound reserves. Sound familiar? China's swap network and regional settlement strategy echoes this. It's the same playbook. Create a regional bloc first, then expand the bloc. And while the public didn't understand what was happening, elites did. Capital moved from Britain into American assets years before the official dollar era was declared. That's what smart money does. It doesn't wait for headlines. It follows the timeline. The Dutch story is even clearer. Amsterdam dominated finance. Then London rose with stronger trade networks, navy power, empire reach. Dutch capital didn't get wiped out. It repositioned. Dutch investors moved wealth into British assets over time. That's how elites survive transitions. So the lesson is simple. Transitions don't happen overnight. They happen through long planning, quiet positioning, infrastructure building, and then a threshold event that makes the new reality undeniable. China's plan is historically fast compared to past transitions. It is compressed by technology and modern capital flows. but it still follows the same mechanism. Now apply this to today. 2014 to 2020 infrastructure built, 2020 to 2027 testing and expansion, 2027 to 2030 potential transition trigger. That's the timeline. And now the most important question, how does China exit a $3 trillion dollar exposure without crashing the system? The core principle is market absorption. If you sell faster than buyers can absorb, prices collapse. China knows this. The treasury market is huge. Daily treasury trading volume is enormous, so China can reduce slowly without dramatic price impact, if it stays patient. That's why China's annual reduction rate has often been modest relative to total market size. It's not dumping, it's draining. And China uses 4 channels to do it. Channel 1, maturity without rollover. Bonds mature, principal returns. China reinvests less into new treasuries. Quiet reduction, no market shock. Channel 2, reserve composition shift. China runs large trade surpluses. Dollars keep flowing in. The question becomes, what do you do with incoming dollars? In the past, more of it went into treasuries. Now, a greater share goes into other assets. Non-dollar bonds, commodities, gold, strategic investments. The point is, every new dollar earned is a choice. China is choosing less treasury exposure. Channel 3, swap network expansion. This is the cleanest strategy. When trade is settled directly in local currencies, the dollar is not needed as an intermediary. That reduces systemic dollar demand without China selling a single bond. Multiply this across many countries, and the effect grows. Channel 4, strategic spending. China uses dollars to purchase real assets and infrastructure. Belt and road, energy supply contracts, ports, rail, mines, hard assets. This converts paper reserves into physical, productive assets that can support Chinese economic security in the next system. This is exactly what elites have always done during transitions: convert paper dominance into real control. Now, here's the part that makes this even bigger. China is not alone. Other countries have reduced treasury exposure too. Foreign ownership share of treasuries has trended down over time. So who absorbs the bonds? Domestic institutions. Banks under regulation, pension funds needing safe assets, and the Federal Reserve, directly or indirectly, through interventions and balance sheet actions. That's how the system stays stable while the foreign exit happens. And what is the release valve? Inflation and currency debasement over time. Not a sudden crash, a slow decline, purchasing power erosion, wages lagging, savings losing real value, no dramatic collapse. Just the quiet cost paid by the population. This isn't conspiracy, it's coordination by incentives. China gets to exit slowly without detonating its own wealth. The US avoids sudden crisis. The public pays through long-term purchasing power loss. Now recap the full picture. China holds trillions in dollar exposure and cannot crash the dollar instantly without hurting itself. But China's strategic goal is to reduce dollar hegemony. So the solution is a managed transition over 15 to 20 years. We are in year 7 of phase 2. Historical precedent shows transitions take decades. China is compressing the timeline using technology and infrastructure. The exit mechanisms are operating in parallel: maturities, reserve shifts, swap networks, strategic spending. Meanwhile, the Fed and domestic buyers absorb the system's needs. Inflation becomes the quiet tax. Conclusion: this is not about if, it is about when. The dollar doesn't disappear, it loses dominance. The most likely trigger window for phase 3 is 2027 to 2030, based on infrastructure maturity and adoption trends. And unlike past transitions, this time you can watch it in real time. You don't need insider information, you can track the indicators. Here's what to watch from now through the next few years. In 2026, watch China's treasury holdings for a break below key thresholds. Watch digital yuan cross-border expansion. Watch BRICS meetings for settlement announcements. Watch Saudi oil settlement trends. Watch CEPs and cross-border activity growth. These are phase 2 validation signals. In 2027, watch if more countries join non-dollar settlement networks. Watch if BRICS formalizes a commodity-linked settlement standard. Watch for global policy debates shifting from dollar world to multipolar system in official language. That's transition preparation. In 2028, Watch for broader adoption outside BRICS. Watch for formal IMF discussions that reflect multi-currency direction. Watch the dollar index for structural weakness, not daily moves. This is where psychology begins to change. By 2029 to 2030, watch for the tipping point, when a meaningful portion of global trade flows through alternative settlement systems and the dollar's reserve share declines enough that the world accepts the new normal. You can track three numbers quarterly: China's treasury holdings, cross-border settlement volumes in non-dollar rails, and the share of global trade settled outside dollars. When these move together, the timeline is confirmed. What does this mean for you? It means you're not helpless. You're early. The British public didn't understand reserve transition until after it happened. You understand it while it's happening. That is an advantage. Dollar assets can still exist and still be valuable, but the premium shifts during transitions. Historically, hard assets preserve value better during reserve shifts. Gold has done that repeatedly. Real assets often do better than pure paper claims in uncertain monetary eras. The point isn't panic. The point is awareness and positioning. We started with a paradox. China holds $850 billion in treasuries, but wants to weaken dollar dominance. Now you see it's not a paradox, it's strategy, a controlled 10-plus year exit plan that avoids self-destruction. This is not prediction, this is pattern recognition. Dutch to British, British to US, now US to a multipolar structure where digital settlement systems reduce monopoly power. The timeline for the Phase 3 trigger is getting closer, and this time, you can see it before it's official. Subscribe if you want to track this timeline quarterly. I'll monitor the indicators, break down the major milestones, and translate the hidden financial moves behind the headlines. Understanding the timeline is the edge. The elites are already positioned. The only question is, will you see it in real time or understand it only after the transition is complete, like if you see the pattern? Comment year 7 if you're tracking this. And subscribe because Phase 3 is coming.